Lecture 4, we're looking at money market instruments and their valuation. So we start with a commercial paper. A commercial paper is a short-term unsecured debt instrument that is issued by corporations, usually to raise funds for working capital needs like salaries. So it matures at a discount of its face value. So the features are that number one, it matures within less than 270 days, mostly between 30 to 90 days. It's unsecured, it's backed by collateral. Um, Denominations a high value of about 100,000 US dollars or more. This instrument is sold below its face value, and investors will earn interest via the price difference. So it's traded in the money market. Why commercial paper offers high yield and treasury bills? Number one, it's credit risk. CPs are not backed by government, so investors will take up risks and hence the return is high. The liquidity, the CP is smaller than a TB in terms of liquidity, so which means that there's lower liquidity. And also tax considerations, the interest from TBs may be tax exempt in some countries, unlike the CPs. So we're going to look at the computations of valuations on the CPs. All right. So we have the following information on the use calculation of a CP. So the formula when you're calculating the discount, it's a future value times R times time over 365. And the formula for the purchase price is simply the difference between um, the discount and the future value. We also have the money market yield, which is given by discount over price times 360 over the time taken and 100%. All right. So we'll look at an example. So suppose we have a 60-day CP, commercial paper, whose face value is 100,000 and the interest rate or discount rate is 7.5%. So being asked to calculate the money market yield. So firstly, to calculate the discount, the formula we're going to use is the face value times our discount rate time over 365. So in this case, we are given our face value, which is 100,000. Then in decimal, our discount rate, which is 7.5%. The period of time is 60 days, so 60 over 365. So when you compute this, you're going to get our value as follows. So we're going to have 1,232. 1,232. Are we together so far? This is our discount value. So to find our, are we together so far? So this is how we calculate the formula for the discount. Then the purchase price is the difference between the discount and the face value. So the purchase price, therefore, will be the 100,000 minus the 1,200. So the difference we're getting is about 98,000. So this is what we call the purchase value. And finally, we go to calculate what we call the money market yield. So it is the discount over the purchase price, 360 times the time, and 100 the percentage. So now this one is very complex in that you need all these value denominations for you to understand. Okay, so a similar question came in the exam where you were asked to calculate the value of the CP. So you needed all that information. at your fingertips. So you need to start from somewhere. So our purchase price is the difference between those two. Now to calculate the money market yield, we are simply using it in this formula. So money market yield, therefore, is given by a discount purchase price 360 over time. So here our discount was what? Was 1,200. And our purchase price was 8,000 times 365 over 60 times 100. So we get 7.95%. So this is the value of the money market yield. Value of the money market yield. So let's go to our exam paper. We see this was an example from the textbook and see how this question was brought here. It was carrying 5 marks. We have a 60-day commercial paper. The nominal value is 100,000 and it is assumed to be at a discount of 7.5 per annum. Calculate the money market yield. All right, so what did you say? How do you calculate the money market yield? Are we given? Who remembers? This one is 5 marks. Yes, Cecilia, what do we do first? What's the formula for the money market yield? Please show more. How do we calculate the money market yield? Anyone?
D.
Mm-hmm.
Hello?
Yes.
Are you
D
getting
over
me?
P.
Yes. D over what? Over P. Uh-huh.
Yeah, times
Mm-hmm.
360
Mm-hmm.
over T
Mm-hmm.
times 100.
Okay. So how do we find the D and how do we find the P? What are we given in here? What is this 100,000? Face value. And what is this 7.5% our rate, discount rate? So how do we find our D? How do we start with it first? How do we find our D? D is what? Face value,
D
discount rate, times what?
discount rate
Mm-hmm.
times days to maturity over 360.
All right, so we use this formula. So what was our future value? What was our face value? 100,000, right?
Yes.
Then what was our rate? 7.5%. Mm-hmm. And what was our time? 60 over what? 365. Okay, are we together? So this is how we find the 60 is coming from the 60-day commercial paper. So when we compute, we find our D as what? 1,200. So this is where the 1,200 is coming from. And how do we find the P? It's the difference between the face value minus what? The discount. Right? So when you get the difference is 98,000. And to find the money market yield, what did we say? It's simply a D over P times 360 The 365 or 360? 365, right? 365.
Excuse me, sir.
Mm-hmm.
When do you use the 360 and the 365?
Days are 365 in a, unless otherwise mentioned, but we use 365.
Okay, thank
We
you.
use 360 when it's mentioned, but it's assuming the year 365 days. So we're clear on how to calculate the money market yield, isn't it? Okay, so this is how we computed this. All right, so suppose we have a 90-day commercial paper issued by a bank or POs ABC Limited, okay, with a face value of 100,000 and our discount rate of 9.5%. So this did not come in the exam. It is another example from the textbook. So the same principle, a discount is face value times 9.5%, 90 days or 360, we get our discount of 2,300. Then the P is what? The purchase price, which is the difference between the discount and our face value, which is 97,000. Then we distribute this in the money market yield formula, which is discount over price 365 over our time of 90 day, then we're going to get 99.7%. Are we together? All right, so we go to negotiable certificates of deposits. So these are large denominations. They are time deposits that are issued by commercial banks and are sold in the secondary markets. So they mature typically 2 weeks to 1 year, and they're transferable but negotiable. They pay fixed rate interest. They can be sold in the secondary market before maturity. So the yield on negotiable CDs is given by the following formula. Selling price SP minus PP purchase price plus interest of a purchase price times 100. So suppose we are given a negotiable certificate of deposit. So um, given as follows. So the investor buys this NCD for 970,000 at maturity where it receives 1 million and 40,000 interest. Calculate the value of this negotiable certificate of deposit. So like we said, what given information do we have? The selling price. So our selling price is what? 1 million. But this is a redemption amount minus the purchase price of 970, which is here, and the interest of 40,000 are there, over the purchase price of 970,000 times 100. So here we're going to get a value of 7.22. So this is only about you understanding what the formulas that are given. Otherwise, there's no complex math that is in there. All right? There's no complex math that is there. So this is a negotiable certificate of deposit. Are we together? So a negotiable certificate of deposit is a short-term instrument in the money market. So it is issued by a bank and mainly represents a fixed deposit. But the key features are that it can be transferable in the secondary market. So the issuer is a bank or financial institution, and these denominations are large for about 100,000 or more. Their maturity will range from a few weeks to 1 year, and their interest is usually higher than savings account. So the negotiability can be sold or they can be transferred in the what? In the secondary market. And this security is usually unsecured and it's backed by the issuing bank's creditworthiness. So it's not withdrawable. It cannot be withdrawn before it just matured without selling to another person. Okay, so it is used, banks will use these ones to raise their short-term funds for operations. The advantages of this is that returns are higher than savings, the liquidity is high due to negotiability, it has low risk, and the fixed maturity will provide their predictable returns. The only limitations are that number one, these ones are what? You have got market risk. If interest raises, the value of this NCD may fall. And also, default is possible if the issuing bank becomes what? Insolvent. And at times, there's lack of access before the maturity. So, unless it's sold in the secondary market. Okay. So, that is how we calculate. So, we go to the repurchase or repos. What is a repurchase agreement? What happens there? So a repurchase agreement, sometimes called a repos, is similar to the NCD. So it's a short-term borrowing agreement where one party will sell securities like government bonds to another person. They have an agreement to repurchase it at a later date, usually overnight or within a few days, but at a higher price. So it functions like a collateral loan. So this security will act as collateral for cash received. So its main key features are that number one, the parties involved, we have the borrower and the lender. The underlying asset could be government treasury bills or high-grade assets. So usually it stays overnight for a few days. So the interest in the repo is the difference between the sale and the purchase price that is quoted. So it is collateralized. So securities here are what? Are pledged. The risk here is low because of the backing of this high collateral. So it is used by banks to manage their short-term liquidity. The central bank, like Zambia, will use them to regulate the money supply in the market, and investors can use these reverse repos in buying securities. So the advantage is that they have low risk, short-term duration, and high liquidity. The risks are that if collateral value falls, there's a market risk. So how do we calculate these repos? We have an example here. The formula for repo is this SP, which is the repurchase price, minus PP, the purchase price, over purchase price times 360 over time times 100. So in an example that we have here, suppose we have a repurchase price of 10 million, and we're given our initial purchase of 9,800 or 9 million. Okay, then the terms of maturity are 60 days. So according to our formula, SP, the repurchase price, which is 10 million, minus PP, which is the initial purchase price, 9 million over 9 million times 360 over 60 days. So here we get our value of the repo at 9.12%. Then we go to our banker's acceptance. So a BA is a time draft that guarantee that a bank will guarantee to make a payment. So in our money market, it is very important to understand how these instruments work. So a banker's acceptance is a short-term and negotiable instrument that is issued by a company and is guaranteed or accepted by a commercial bank. It's usually used in international trade transactions, typically for payments for goods and services in the future. So it works like a post-dated check in simple language. It makes it more trustworthy when the banks come in. It's tradable usually in the secondary market. So the issuer in this case is a business or the exporter or importer. The guarantor is a commercial bank who accepts what? Uh, the payment. The maturity is typically 30 to 180 days for these ones. They're usually sold at a discount at maturity. So the formula is the yield is the face value minus the price, purchase price over price times 365 over time times 100. So there are steps that must be adhered to when we are looking at the banker's acceptances. The first one is that the importer will request a letter of credit from the bank in favor of the exporter. And the exporter will ship the goods and submit the document to the bank. Then the exporter's bank will send the documents to the importer's bank. And the importer's bank will stamp as accepted on the draft, creating a banker's acceptance official. So the BA is sent back to the exporter's bank, which can then sell it in the secondary market. So the importer will deposit funds with their bank for payment at maturity. Okay, so the formula as has been given is face value minus price over price times 365 over time. So the advantages of the BA is that number one, immediate payment is given to the exporter. It also reduces foreign exchange risk. An exporter doesn't access the exporter doesn't assess importer's creditworthiness because the bank is a guarantee, and this instrument is active in the secondary market. So let's look at a summary of the instruments we've talked about today. Treasury bill, there's no collateral. It's traded at a discount. The difference between the face value and the price is what the investor will get. Liquidity is high. Maturity is within 4 to 52 weeks. The commercial paper, no collateral either. It is traded at a discount, and we're looking at price appreciation. Liquidity is medium with less than 270 days. Negotiable certificates of deposit, these ones require collateral and they're traded at interest. The yield is interest plus capital gain, if any, and it's a medium liquidity of up to a year. Repos requires collateral and traded at an agreed terms. So the difference between the sale and the repurchase prices is what you, the investors, will get. The liquidity is high and time maturity is overnight to 3 months. The banker's acceptance requires collateral who's a bank and is traded at the discount. And the yield is a discount on the face value. The liquidity is medium and the time is about 30 to 270 days. Right. So quickly, let's go back to the exam question. Still on question number 2. Outline the steps involved in banker's acceptance. Who remembers what are the steps that are required? What is step 1? What is our first step? We said step 1 is the importer will request a letter of credit, isn't it? And secondly, the exporter will ship the goods and submit the documents to the bank. Thirdly, the exporter's bank will send documents to the importer's bank. Number 4, the importer will stamp as accepted and will create the BA. Then the BA is sent back to the exporter's bank, which can then sell in the secondary market. Then the importer will deposit funds to their bank for payment. So these are the steps that will carry about 10 marks. Are we together? Anyone who's
Yes.
behind? All right, so tomorrow we'll start the bond market. So please read chapter 4 of your modules so we understand what happens in the bond market and how the valuation is done. Hey, thank you so much for your time.